Right now, someone watching this video is about to make a decision that will quietly drain their net worth for the next 10 years. They won't realize it. Their broker won't tell them, and every financial influencer celebrating passive income on Instagram is making it worse. Here's what the internet actually tells you. Dividends are free money. High yield equals high income. Buy dividend stocks and retire early. Sounds beautiful, right? Wrong. For most beginners, and honestly for a shocking number of experienced investors, dividend investing as it is commonly practiced is not a path to freedom. It is what I call the dangerous illusion of being rich. You feel wealthy, you get a little deposit every quarter, you screenshot it, maybe you post it. But quietly, behind the scenes, your actual net worth is bleeding out. Your capital is eroding, your tax bill is growing, and the compound curve, the one that was supposed to make you a millionaire, has been completely flatlined. I'm not here to tell you dividend investing is bad. I'm here to tell you that doing it wrong is one of the most expensive financial mistakes you can make. Because unlike blowing money on a car or a vacation, at least you know that money is gone. With these 5 mistakes, the money disappears slowly, invisibly, while you think you're building wealth. This is the invisible prison of dividend investing. Today, we're blowing the door wide open. 5 mistakes, brutal math, no fluff. Let's go. Let me ask you something. You're browsing your brokerage. You see 2 stocks. Stock A, 3% dividend yield. Stock B, 14% dividend yield. Which one do you click? If you said 14%, congratulations, you just fell for the single most common, most devastating mistake in all of dividend investing. I call it the yield trap, and it is the ultimate middle-class mistake. Here's why your brain does this. When you see 14%, your brain doesn't run a spreadsheet, it runs a dopamine loop. Your brain says, 14%? That's free money. I just found a cheat code. This is a documented behavioral psychology phenomenon called present bias. Humans are hardwired to dramatically overweight immediate rewards and completely ignore future risks. It's the same reason people eat the cookie instead of going to the gym. And in dividend investing, it will absolutely wreck you. Here's the brutal math. Say you find a stock, let's call it Dividend Trap Inc., yielding 14%. You think, if I invest $50,000, I'm making $7,000 a year in passive income. That's nearly $600 a month. I'm basically retired. Except here's what that 14% yield is actually telling you. Yield is calculated as annual dividend divided by stock price. When a yield is astronomically high, 2 things, usually both, are happening. Number 1, the stock price has already collapsed, which means the market has already looked at this company and said, we don't trust this. The yield looks huge because you're dividing by a stock that's already been cut in half. Number 2, the company is literally borrowing money to pay you that dividend. They're taking on debt to maintain the illusion of being a healthy, dividend-paying business. They are financially engineering their own destruction just to keep yield chasers like us from selling. This is not passive income. This is a company handing you small pieces of your own money back, just slowly enough that you don't notice the whole thing is burning down. Real-world example, multiple well-known telecom and energy companies have done exactly this. Massive yields, loyal dividend investors, and then dividend cut. Stock price craters 40%. Investors who were collecting income are now sitting on catastrophic losses that years of those dividend payments cannot cover. Stop chasing yield. Start chasing quality. This is where it gets really personal, because this mistake is 90% emotional and only 10% mathematical. Here's the scenario. You bought 100 shares of a company at $50 each. Total investment, $5,000. The stock pays a 5% dividend, so every quarter you get a check, roughly $62.65. Feels incredible, right? You tell your friends, you post it, you're living the dream. Except while you were celebrating that $62.50 check, the stock price quietly dropped from $50 to $44. Your 100 shares now worth $4,400.
You received $62.50, you lost $600 in principal. This is called total return, and it is the only number that actually matters. Not the yield, not the dividend check, the total return. Here's why most financial advisors won't show you this analysis. Because income is a feeling. It's tangible. You can show a client a dividend check and they feel safe, productive, validated. Showing them a total return chart, that reveals whether the strategy is actually working. And sometimes it isn't, and nobody wants to have that conversation. Now let me show you the comparison that should make every yield chaser seriously uncomfortable. Company A, you invest $10,000, 10% yield. You collect $1,000 in year 1, but the stock drops 8% annually because the business is in structural decline. After 10 years, your principal is worth approximately $4,344. You collected roughly $7,200 in dividends, declining over time as they cut the payout. Total, approximately $11,544. Company B, you invest $10,000, 2% yield, but the business grows 12% annually and raises its dividend every year. After 10 years, your principal is worth approximately $31,058. You collected roughly $3,400 in dividends, growing every year. Total, approximately $34,458. Same 10 years, almost 3 times the result. This is the hidden math that the dividend influencer community does not want to put in their thumbnails. Because 2% yield doesn't go viral, 10% passive income does. Don't let your emotions manage your money. Here's something nobody warns you about when you start chasing dividends. The highest yielding sectors in the market are almost always REITs, utilities, banks, telecoms. So naturally, a beginner goes hunting for yield, and without even realizing it, they've put 80% of their entire portfolio into 2 sectors. This is what I call the diversification trap, and it rhymes almost perfectly with what I call the crypto trap. Remember 2022? People who put everything into crypto didn't just lose money on one bad bet. They lost money across every single asset they owned because all their assets were correlated. When one fell, everything fell. No cushion, no escape. Sector concentration in dividend stocks does the exact same thing. When interest rates rise sharply, what happens to REITs? They get absolutely crushed because REITs borrow heavily, and higher interest means higher borrowing costs, lower profit margins, and lower dividends. When real estate slows down, REITs bleed. When banks face a credit crisis, your banking dividend stocks bleed. When the grid needs a $1 trillion upgrade, your utilities get squeezed. Every one of your safe income streams gets hit simultaneously because they're all the same stream. Now, I'm not saying don't own REITs or utilities. I'm saying if that is your portfolio, stop right now. The solution is straightforward. First, spread your dividend exposure across multiple sectors. Technology has dividend payers. Healthcare has dividend payers. Consumer staples, industrials. You can build an income portfolio without putting all your faith in interest rate-sensitive sectors. Second, consider a broad dividend ETF as your core holding, something like a dividend growth ETF that's already diversified across sectors by design. Let the index do the diversification work for you. You don't need to be a genius stock picker. You need to stop recreating the exact same risk in 10 different stock symbols and calling it diversification. We're in the home stretch. 2 more mistakes, both will quietly ambush you. You know what compound interest is, right? The 8th wonder of the world. Einstein may or may not have said that, but the math absolutely backs it up. The entire power of dividend investing, the reason it can actually make you wealthy, is reinvestment. When you receive a dividend and you reinvest it to buy more shares, those new shares generate their own dividends, which buy more shares, which generate more dividends. This is the snowball effect, and over 20 or 30 years, it is genuinely life-changing. Here's the brutal comparison. $10,000 invested, 4% yield, 7% annual stock appreciation. Reinvesting dividends for 30 years, approximately $174,000. Spending dividends as cash for 30 years, approximately $76,000. Same starting investment, same stock. The only difference is whether you spent the dividend check or put it back to work. That's nearly $100,000 in lost wealth, gone to ego purchases, lifestyle inflation, and the psychological reward of feeling rich while becoming poorer in real terms. This is what I call the ego purchase tax. When you spend a dividend check to treat yourself during the accumulation phase, you are literally borrowing from your future self at a massive interest rate. The fix? Activate DRIP, Dividend Reinvestment Plans. Your brokerage likely offers it with a single toggle. Every major platform has it. Turn it on, walk away. Let the snowball roll. Do not touch it. This one is sneaky and expensive. Not all dividends are treated equally by the tax code. There are two types: qualified dividends, taxed at the long-term capital gains rate, depending on your income bracket.
This could be 0%, 15%, or 20%. Ordinary, unqualified dividends, taxed as regular income, same rate as your paycheck. If you're in the 32% or 37% bracket, you're handing a third of every dividend check directly to the government, every single year. Many high-yield assets, certain REITs, bond funds, covered call ETF, generate ordinary dividends, which means holding them in a regular taxable brokerage account creates massive tax drag year after year. The solution is elegant. Put high-yield ordinary dividend assets inside tax-advantaged accounts, your IRA, your Roth IRA, your 401k. Let them compound without the annual tax hit. Hold your qualified dividend growth stocks in your taxable account, where the tax treatment is already favorable. This is called asset location, and most beginners have never even heard of it. It costs you nothing to restructure this. It saves you potentially tens of thousands of dollars. Okay, you've made it through the 5 mistakes. Let's talk about what actually works. Because I didn't make this video to scare you away from dividend investing. I made it to redirect you toward the right version of it. Here's the framework, clean and simple. Step 1, hunt for dividend growth, not high yield. Look for companies with a history of raising your dividends, 5, 10, 15 consecutive years of increases. These are businesses generating real cash flow. The dividend growth itself is proof the underlying business is healthy. Step 2, always evaluate total return. Before you buy any dividend stock, run the total return math. Stock appreciation plus dividends. If the stock has been declining for 3 years and the yield looks great, walk away. The yield is a symptom, not a solution. Step 3, diversify across sectors. Use a dividend growth ETF as your foundation. Add individual sector exposure carefully and intentionally. Never let any single sector exceed 25% of your dividend income. Step 4, activate DRIP immediately. Leave it alone. During the accumulation phase, which for most of you watching this is right now, you do not spend dividends. You reinvest every single one. You are not building an income stream yet. You are building the machine that will eventually produce that income stream. And step 5, asset location. High-yield ordinary dividend assets belong in tax-sheltered accounts. Dividend growth stocks belong in taxable accounts. One conversation with a fee-only financial advisor or 1 hour of research on this alone could save you tens of thousands of dollars over your investing lifetime. Here's the reframe I want you to leave with today. Real wealth, lasting wealth, is not about the biggest yield number on a screen. It's not about the quarterly check you screenshot and post. Real wealth is the kind that works without you, quietly, efficiently, getting bigger while you sleep, while you travel, while you're present with the people you love. That is wealth without burnout. But it only happens when you stop making these 5 mistakes, when you stop yield chasing, when you run the real math, when you diversify properly, when you let the snowball roll,
and when you stop donating your returns to the IRS unnecessarily. The middle class stays stuck because nobody shows them these numbers. You now have the numbers, so stop making middle-class mistakes and start building real wealth. Here's where I lean in. If this video pulled back the curtain on something you needed to see, smash that subscribe button right now, because every week I'm bringing you the brutal math and the real frameworks that the financial media doesn't want to make simple for you. Drop a comment below. Which of these 5 mistakes were you closest to making? I read every single one. And if you want to go deeper on building your actual dividend growth portfolio from scratch, the next video is already queued up for you. See you there.